Board, Mr. Sunil Duggal, Chief Executive Officer with Dabur India. Sunil, good morning. Thank you for joining us. Before we get into specific categories, are you delighted and finally are you breathing a sigh of relief that food price inflation has come down, something which will benefit Dabur immensely and the entire FMCG industry?
Well, it's still to be reflected in our purchase costs, but yes, it's a good sign because food inflation was the single largest contributor to our overall material inflation. So if that cools off, it would certainly put less pressure on pricing and increase consumer offtake.
Sunil, hi, morning. So tell us how the March quarter has been for the company, morning. And do we get to see any expansion in this particular quarter?
We'll be detailing results on the 30th of this month, so you'll know the numbers then. All I can say is that the demand is holding up, so we are reasonably happy with the situation as it is. And hopefully the demand resilience will continue in the quarters to come.
Sunil, some of your peers have indicated that in the near term, the entire Indian FMCG industry, especially the food part of the business, is going through a severe volume degrowth. Is that your experience as well, or the kind of product categories you are in, there is no evidence of any volume slowdown?
Well, we don't have a huge exposure to food. Something like 20% of our business, domestic business, is food, and none of the international business comprises of that segment. In our case, our food growth has perhaps been the highest amongst all our business segments other than home care. So we've not felt any demand recession, but then we play at the periphery of the food market. We are not mainstream food company. So perhaps we are not representative of the category as a whole. But our food business has done extremely well in the last few quarters.
Sunil, I must congratulate you, while the rest of the market is looking extremely under pressure and in pain. Even a week that saw market losses of about 2%, your stock has been making fresh highs after fresh highs. Currently, again, it's sitting at a record high for itself. Let's just bring up the Dabur stock price, in fact, for you and show you how the intraday chart has been panning out. And it will just come up for you on your screens. A good 1% move is what you've seen on Dabur. 144 is where the stock is. Sunil, what prompts investors to go long onto the stock even in a market environment like this? What is it that they're reading that you're not telling us?
Well, I really don't know, and I've stopped predicting the stock market long time ago. But I think perhaps we had a little bit of catching up to do, and the last few quarters have been good in terms of sustainability of our results. And perhaps there is expectation that we'll be able to maintain the current trajectory.
Sunil, you've told me about 20% of your business, which is the food business. What about the remaining 80 business? The personal care market, the home care market, what's happening?
We are talking about domestic business here. Of the remaining 80, close to 50 is home and personal care, and around 30 is healthcare. And all of them are reasonably steady, so there are pockets of high growth and low growth in both these segments. But overall trajectory, we are maintaining somewhere in the region of 10% volume growth over the last few quarters, averaging 10, sometimes 11, sometimes 8 or 9. Let's see if we can maintain this trajectory, because the economic scenario obviously is not that easy. Economic stimuli perhaps will be a little bit less going forward than it has been, so that may put some pressure on demand. So if we are able to maintain a double-digit volume growth, that would be pretty good under the circumstances. We've been doing it so far. Let's hope we are able to do that in the next few quarters.
So Sunil, you're saying that you're going to maintain your guidance of 8 to 10% volume growth at a time when the industry is seeing a decline in volumes due to the decline in discretionary spends?
Well, I would fall short of calling it a guidance. It's more in terms of an expectation that we, with all the infrastructure building which we have done in sales and distribution, particularly in rural India, we'll be able to maintain this 8 to 10%, perhaps a little bit ahead of that trajectory in the quarters to come. But 10% is something which we are shooting for, and so far we've been able to get to that target.
Sunil, but your ad spends in the last in the first 9 months have increased. Do we see the same trend going forward? Could you tell us what kind of ad expenses can one see from you guys in FY14?
Well, the outlook as we speak is that we'll be maintaining the current levels of ad spends in the next year. Having said that, if inflation becomes a little bit too high, we may have no option but to trim them a little bit. But given a situation of moderate inflation, we would see ad pros leveling off at current levels, at least in the next few quarters.
Sunil, for Dabur India, how will FY14 be different from FY13? Are you looking at new launches, more consolidation, or you will be only focusing on market share gain?
I think it will be a mix of few launches, but perhaps larger in terms of ticket size. So we'll be investing in fewer ventures, but investing more heavily behind them. At the same time, there will be a lot of consolidation happening. I think we still have a lot of work to do in building scale into some existing categories like skincare and OTC healthcare. So it will be a mix of both. I think overall, as a company, in terms of international business, it will be more of consolidation. In India, it would be a blend of consolidation and growth through new initiatives.
Now, the gaps in your portfolio, where you're hunting for ideas or you're hunting for options?
Yes. Well, there are gaps, and I think gaps exist in most parts of our portfolio. Now, it's not something which we definitely need to fill, but if they are a logical extension of our current brand architecture, then we can perhaps occupy those slots at reasonably low cost. And that is what we would seek to do in whether it's home and personal care or parts of healthcare or even food and beverage. So there is a lot of extendability which we see in our brands, whether it's Vatika or Dabur or Real or any other. And I think it makes sense to expand the brands into areas which are adjacent to where we are present, and that would give us impetus for growth at comparatively low cost.
There's a very strong reach even in rural India. So reach may not be the mantra for any Indian FMCG company, but most of the FMCG companies are really planning to go up the value chain. How are you planning to differentiate? Because competition also has intensified. If I look at MNC FMCG companies, all of them are only focusing on value creation.
Yeah, exactly. We see reach as a means to value creation. It's not really just raw numbers and getting to the last mile. It's really improving the quality of our distribution through the improved reach by having larger number of products at the last mile, offering higher margins and returns to the company. And that is really the objective. It's in terms of raw numbers, we are present in 5.5 million outlets, which is an enormous number. What we have to really do is to ensure a wider array of product availability in these as many of these 5.5 million as possible. And that can only be done through having a much larger control over the last mile and having a distribution infrastructure which is far more sophisticated than perhaps what we've been having over these years, when the emphasis really was just on building numbers and not really improving the portfolio width at the last mile.
Sunil, the currency has depreciated a good 1% already this month. Tell us the impact of the fluctuation which one would see on your margins, considering you import about, 40% of your raw materials?
Not really. I mean, in one form or the other, yes, they are imported because all the oil derivatives are imported. But direct imports in terms of, the forex being having an outflow is around 10% of our portfolio. But we also have some exports, so we do have a natural hedge in terms of export and export. So I don't think forex would really have any great impact on the business overall. It would impact margins, let's say, of our beverage business, which is highly import dependent. But in terms of aggregate business, depreciation actually has not hurt us in the past to any large extent.
So we really appreciate your time, and thank you for your wonderful insights, and I really look forward to seeing more of you in this financial year. Okay, moving on. Getting out of the current economic slowdown won't be easy, but the government's efforts are in full swing. That's the message coming from the Chief Economic Advisor